Welcome to the show. This is On the Markets from Sonoma Wealth Advisors. My name is Dano Weir. I'm the marketing director, joined shortly by our managing principals, Chris Sipes and Daren Blonski. This is our weekly look at the markets, stock markets, the economy, alternatives. And this time of year, we're in a little bit of a summer float. Everything is looking green. Everything is rolling along. And does that mean that a correction might be around the corner? Also, some changes coming to tariffs in August we'll look at. Jobs numbers, unemployment is allegedly low, but I have some questions about that. But first, let's get the show started. It's July 25th, 2025. We're cruising along as if we're sitting in a lazy river. Daren, what is, as you call it, the summer float in the market?
Well, there's a lot of people out floating in the water, Dan, and because of that, you have less volume in the market. Signals we see coming in kind of late July, August, we don't tend to get too excited about from a market standpoint. There is a seasonality to this on some level. It's not always float higher in August, but that sure looks like what's happening at the moment. We have had August where things went down pretty substantially, but typically coming back into September when people are done floating and the market's done floating higher with the less volume, then we tend to see more of a correction going into September. And it will be some kind of fanciful headline, tariffs or war or you name it. And we typically see some market down through September, early October, and then it ramps into the end of the year because you guessed it. People get their bonuses in the end of the year in Wall Street. And so, hey, we got to finish the year strong, right?
Chris, hit me with the hedge eye.
Hedge eye with another great cartoon this week. And so for those of you that are just listening and not watching, it's a psychiatrist or psychologist sitting with a picture of Jerome Powell, and the psychologist saying, "The good news, Chairman Powell, is that you are not paranoid. He definitely is out to get you."
Now,
Pretty funny.
I've been out of pocket this week on a trip with the family, so I just got back. What was that construction? It looked like an interview with Trump and Powell. They're standing next to each other. What? And then they are disagreeing on camera. What was that, Chris?
Well, you're I guess foreshadowing another meme that we have, but that was President Trump visiting Chairman Powell to, I guess, talk about the overruns at the Federal Reserve. It was very strange. I thought that the whole angle of the administration was that they were going to make a big deal out of these cost overruns at the Federal Reserve so that they could get rid of Chairman Powell, because they can't get rid of him without having cause. They have to do it for cause. And so it looked like they were drum beating this cause up, on the renovations of the Federal Reserve buildings, I guess. I don't know. But then they went there and met together, and President Trump was basically like, it was a really like kind of cringy conversation between the two of them. And then he resolved it with like, "Nah, I'm not going to fire him," So it was like, what in the world? I don't know, Dan. As I was saying earlier, I've started to look at it as kind of like, with Hulk Hogan passing this week. I'm a child of the '80s, so he was big for me, and starting to look at more of modern life as just the WWF or the WWE, right? You can't take it literally or seriously. You just have fun with it because a lot of it just is for show and entertainment, and there's storylines and there's narratives, and most of it is just for entertainment, right? And I feel like that's given me a peace of mind to understand our modern life.
I was actually flying through Miami airport once and saw the mighty Hulk Hogan, and he's a big boy for sure. I can confirm that, or was a big boy.
Well, we also lost Ozzy Osbourne this week, and I had to look it up. I'm like, which one of those two actually lived longer? And of course, it was Ozzy Osbourne.
Yeah,
Not by
crazy.
much, but
Yeah.
slightly. And so
And Keith Richards keeps on plugging away.
yeah, it's gonna
Somehow.
live forever.
Just a quick update. We are, my name is Dano Weir, Chris Sipes and Daren Blonski, CFP AIF. Both of them, they are the managing principals of our firm, Sonoma Wealth Advisors. And our family of brands also includes Fermata 401k and Fermata Tax Advisors. So some information on who we are if you're just meeting us. And guys, I was at Disneyland this past couple of days. I won't go off on it, but Chris, I'm excited to see you've got a Disney.
I'm
Disney
sorry.
theme here. No, that's the place. Trump was trying to get back there. Yeah, Chris, what's with this meme?
Are you trying to tell me, Dan, that your financial plan is completely wrecked now?
Well, no, the plan actually was there's retirement is not part of the plan. The plan is just to get to Disney. So I achieved my plan and then spend all the money there.
Yes. Okay. All right. Plan was successful.
Yeah.
Yeah. So we've got Stockholm syndrome. Stonks. Buy stonks. That's the meme of the last few years, and we got the, I guess, good news on the Japan trade deal this week, and this is showing Beauty and the Beast, and she's afraid and scared, and everything's dark with 25% tariffs, but with 15% tariffs, they're dancing through the ballroom and in love. So, and the market really liked this deal this week, and we saw a big rally in the international stocks, which Japan makes roughly about 25% of the developed markets index. So it's a significant portion, and so we saw a nice little rally there to continue in the international stocks this year so far. Which, when we look at, this is from Kevin Gordon at Schwab, and the tariff rates now versus April 2nd. So this is the Stockholm syndrome we're all experiencing. Rates are not that much different. Everybody was freaking out in April, and somehow everything's fine now. I can't explain it, Dan. I don't know if anybody really can, but it is what it is. Here we are. People seem to be, accepting of it at this point, and moving forward. Now, I will say, a lot of people have said, "Hey, these are going to be inflationary," because it's kind of level one thinking of the tariff is an additional cost on the good, therefore prices on that good are going to go up. And I've recently heard a few people arguing the opposite side of that, where, hey, if you said this was a tax instead of a tariff, are taxes inflationary? Because usually taxes are not inflationary because they reduce growth, and people just don't, consume as much. I don't know which way this will play out, but it's been interesting, to kind of explore that thought process of like, hey, if we're just increasing taxes on these folks, 10, 15, 20% across the board, whatever it is that really going to lead to inflation, or is it going to lead to people just consuming less of it, and therefore the inflationary effects are less so? I think you could make intelligent arguments on either side, and it's going to be interesting to see how it plays out.
I can tell you what will lead to inflation, because it has, which is nearly no tariffs and printing a bunch of money. So we know that makes inflation. We have data on that.
Did you guys watch the actual full video of this picture?
No.
I think I sent it.
Unfortunately, yes.
Just one clip.
It was
Yeah.
hilarious, where Trump was like, "Oh, it's 3.7 billion," and Chair Powell grabs the paper, looks at it, and he goes, "You guys added the building next door," and like rolls his eyes. It was classic.
He's like, we built that 5 years ago. It was so tense. it was very tense. But guys, the gift is that we've moved off of the Coldplay memes onto a new meme. I've seen so many funny memes on this now where, one guy said, my wife, when I show her that I made out a vacation itinerary, that one killed me. There's so many good ones. So yeah, Powell looks at the paper and he cringes up and is like, what is this? It was the weirdest thing. Like I said, WWF, WWE, and it's like, oh, this makes sense. This makes sense.
Trump, you don't know this, but Trump is actually in the WWE Hall of Fame. For real.
Oh,
yes.
That makes sense. He is
I didn't even know
master.
there was a WWE Hall of Fame. Who knew?
Now, so this is a situation where this narrative has been blown up that Powell is just doing an awful job, that it's just unbelievable, how bad he's doing, et cetera, et cetera. We talked last week a lot about the inflation narrative and how inflation on most fronts looks to be somewhat tamed, but still elevated relative to where it's been historically. And to just remind everybody, the Fed has a dual mandate, which is price stability, aka don't let inflation get too hot, don't let deflation take hold where prices start falling, and full employment. So keep the employment numbers good, right? And so when you look at the initial employment claims, so the other side of their dual mandate, we've been in this. I mean, Daren, I know you and I have been looking at this number for years. Every Thursday, they put out the initial claims, and it's always 200, 210, 199. So we've been in this range really since we came out of COVID. So no movement on the side of like, hey, there's starting to be a lot of unemployment that we need to start worrying about, right? So where's the impetus to lower the rates based on inflation being completely tamed, employment being starting to tick up, and so if you go to the,
I will say with all these job loss data, I don't know if you saw this earlier, but like they're saying 400,000 of the jobs that were created during the last administration at the end of the year were all bogus now. So that's one topic. Another topic on this unemployment rate, the unemployment rate for young professionals who are going into the workforce is approaching, I think 9% is the last number I saw.
Yeah.
And a lot of the discussion is that the AI world is starting to take the entry-level jobs, which is problematic, right? So I think when you dig into the data, it doesn't look that bad right now. There are other issues underneath.
That was my question that I have, Chris, because I saw these slides as I was loading them into the system here, and great, it looks like it's the graph is low, ta-da, and yet my brain knows that I'm seeing nothing but CEOs on LinkedIn talking about how 50% of their customer service is now AI. And what about all those federal cuts and all those posts I saw about the park rangers who had dedicated half their life to Yosemite and now they're out of a job? So I feel like there are counter narratives here that just, it feels like something's not adding up.
Right. And it's absolutely possible, but in terms of the official data, which is what the Fed goes off of. So if the official data is bogus, or at least, some issues with it, that may be possible, but that's what the Fed's going off of to look at, should we lower interest rates? Because lowering interest rates is a stimulus to the economy. And, I think, and you have to worry about inflation coming back. So what's the impetus to stimulate at this point? We've got stocks at all-time high. We've got real estate at all-time highs. We've got unemployment under 5%, which is historic lows, and no upticks in initial claims. So I think it's a really tough case. And I know some people are making the case that it should be lower regardless. And maybe that's true slightly. That the rate should be lower, but I don't know how you can make the case that the rate needs to be dramatically lower. given these numbers. So
I
this
asked-
this is
I
the
asked-
unemployment rate here. Yeah, go ahead.
Chris, I asked Google Gemini just so I can confirm this data. This is important. I want to make sure we're factual here. Yes, Donald Trump is in the WWE Hall of Fame. He was inducted in 2013 for his role in WrestleMania 4 and 5 during the Battle of the Billionaires. So I wanted to make sure we got that out
Wow.
there factually.
You learn something new every day. That's the goal.
Wow, Dan,
That
thanks for
is the
nailing
goal.
that fact.
Yeah,
Right.
this is what I'm here for.
Fun fact.
Can't
Hey,
believe that's even a thing.
okay, so days between all-time highs, and obviously the bigger the triangle here, the longer the S&P has gone without hitting an all-time high. And I think that when you take a look at this, it's apparent that usually these things cycle in groups, right? So it tends to cluster. Bad markets tend to cluster. Good markets tend to cluster. And we've definitely been in a good market since, call it 2010, 2011, when the market recovered from the great financial crisis. And then really since 2018, we've had, every drop has been aggressively bought, and the S&P has come back extremely quickly. And I'll just say anecdotally, I'm hearing a lot of people say, not only clients, but also advisors, that the S&P is quote unquote safe, and there's nothing to worry about, those kind of vibes. / maybe you want to diversify with the NASDAQ. if you're gonna diversify at all, diversify with the NASDAQ, which those stocks, many are in both indices and highly concentrated within there. So I would just caution folks, maybe we have seen the end of an era, and now, moving forward, everything is going to be different and history no longer applies. But also maybe not, because those are the types of things that you often hear, in the middle of bull markets or at the end of bull markets. So this chart from Ritholtz is kind of illustrating that. Now, the 2010s are not on here. However, if it was, we just experienced the best 15-year rolling average in the S&P. So if the 2010s were on here, that bar chart would be up there with the 1980s in terms of total returns. And again, here you see that those things tend to cluster. We get really good decades, then not so good decades. And if we just had a great decade, maybe the best decade, I think it warrants a little more caution than just saying, yep, it's totally different now. No risk is in the S&P anymore. And these are the greatest companies ever. Nothing to worry about. They said that about the, what do they call them? The Fabulous 50? No, that's not right. There was something about the 50 best stocks. You guys remember what that was called? Anyway. They had a name for it as well, back in the 60s, and something that rhymes with 50. And it was companies like Kodak that you basically, at the time, the thought was you couldn't lose, right? And who would have ever thunk that we were going to get, the technology that just eliminated Kodak, basically.
The Nifty 50, Chris.
The Nifty 50. Yes, the Nifty 50. Thank you, Dano. So that was a similar vibe back then. The Nifty 50, it was all companies that everybody knew, everybody was comfortable with, and essentially everybody was saying, "Hey, you can't lose. There's no way." And then we all know what happened from there. So the other thing is that we are, relative to history, at a fairly high valuation metric. And again, a lot of people say valuations just don't matter anymore. And there probably is some truth to that. I will not say that valuations are a good timing tool. They're absolutely not a good timing tool. However, when you're looking at what's the possible upside versus the downside, I think it's at least worth considering when you look at a chart like this from Charlie Biello showing the price to peak earnings ratio. We've only been higher one other time, and that was during the dot-com bubble in 2000. So, and we've been at these elevated levels really since 2020, when that peak initially hit 25. So, you look at that historical median down at 17 times earnings. What this means is that what is the price of the company versus its earnings? So it's a multiple of its earnings. That's one way that's commonly referred to for valuation purposes.
Can you put some simple math to that, Chris? Just like round numbers so people could conceptualize
So
that?
if your company earns $1 and you're selling that company for $10 a share, that company would have a 10 times price to earnings ratio. Now, probably most people don't think that that's even possible, a 10 times price to earnings ratio, but that has happened before. And in fact, in the early 80s, when the bull market started in 82, the S&P was trading under, as a group, the S&P 500 was trading for under 10 price to earnings ratio. And now we're in the mid 20s. And so now Japan, they got to a cyclical price to earnings peak of 100 back in the 80s. That is a 10-year smooth earnings. So this could get crazier. Again, valuations are not used for timing, because crazy things can and do happen, because it's just a human market, and we as humans love stories, and we buy into stories.
Evaluations. I don't know if you saw this, because I know you're a big Warren Buffett fan. There's the Warren Buffett indicator, which is the Wilshire 5000 to the GDP ratio, which is the gross domestic product ratio. So when we pull a ratio off the Wilshire 5000 to GDP, you get kind of what we call the Warren Buffett indicator. And the Warren Buffett indicator has, from a valuation standpoint, it is the most expensive stock market in history, now surpassing the dot-com bubble and the global financial crisis, which is pretty gnarly. I contend that, we've talked about this before. There's this S-curve of adoption that happens, right, with technology. We saw it really pronounced in the dot-com bubble, where everything was going to be .com, and then it crashed and nothing was going to be .com, and then .com became everything. I still think we're in for an S-curve adoption on AI. I just wonder how much that dip will be, given how fast the adoption curve is happening with AI. But that would be the thesis right now, right? That the valuations are really extended, like they were in the .com, and everything's AI, and then all of a sudden it's not AI, but then the market goes down, but then it really starts to change all of our lives after that. I still think that is the expected. It would be unexpected if that didn't happen, which is really hard then to look at this stock market going up and up and up and up and not just buy into it and say, well, it's never going down again, especially when every time it goes down, the politicians stimulate the economy and stimulate the markets.
So, Daren, let me speak into existence. You're unspoken here. Would this be a time then, depending on everyone's situation, because everyone's different, but are you perhaps preaching diversification right now against the S&P?
Well, man, that's a hard one, right? Because if you preached, and we do preach diversification, so yes, I'm always preaching diversification, but because when you preach diversification and you have growth through concentration, those people who are diversified in the short run don't do as well as those people who are concentrated. And that's really hard for investors to sit and watch. What we find over time is things revert to the mean, though. And that's what I'm preaching, is that this will probably come back down. This probably is not forever. The Warren Buffett indicator is saying it's the most overvalued market in history. that will probably come down at some point. How it comes down, to what degree it comes down, and how structurally it comes down, I think that's where the jury is out.
Yeah, Dan, sometimes you can make wrong decisions and the outcomes can still be good. You know, the Ozzy Osbournes can still outlive the Hulk Hogans of the world. It happens, right? It happens all the time. But that doesn't mean that diversification is a bad idea, especially in the long run, you know. I would argue. So now, when we look at the concentration in the S&P 500, this one again from Charlie Biello showing the weighting of the top holding. This goes back to 1980, and NVIDIA is now the largest holding within the S&P as far as a weighting perspective that any one stock has ever been in the history of the S&P 500. So could that continue? Could NVIDIA eventually be 20%, 25% of the S&P 500? I suppose it could. And I think it's also possible that AI does change the world and changes our lives and will. However, the market doesn't necessarily need to continue to reward that forever. Just like the internet situation happened where, you know, remember back to that time when internet stocks were all the rage. The internet did change everything for us. You know, it absolutely changed everything in every aspect of our lives, made us way more productive in everything. And it all got priced into the point where had you bought in at, you know, the peak in 1999, you went nowhere for, you know, over 10 years. So, and the longer I've been working with people, investing money, and longer I've been investing my own money, I realize that investing years are like dog years, right? Especially when you're underperforming. If you underperform for a year, you feel like it's 7 years. It's the longest period of time ever, you know? So it's investing dog years. And so you got to kind of be careful of that.
Instead of 7 years in Tibet, it's 7 years in bonds.
Yeah. Yes. Yeah. Okay. So sentiment, we're back to normal in sentiment. You know, like Daren said, everybody's floating in the water and they're just kind of meh about the markets. We've still got the CNN Fear and Greed Index at 75. That's unchanged. That's extreme greed, but just slightly into extreme greed zone. And then we've got Bitcoin at 70, down just slightly from 73, which is also the greed zone, but not extreme greed. We've really seen Bitcoin kind of bouncing around in that same area for a while, so it's not surprising to see the sentiment kind of just floating along with that. Now, some kind of abnormal things that are happening, and one is in the housing market. We hit, and this is from Heather Long, 2025 is on track to be one of the worst years for home sales in the past 30 years. I should have prefaced this with saying anybody with children, especially, you know, young millennials and Gen Z, you might want to have them leave the room while we talk about these next two slides because it's just going to be probably too traumatic for them. But the housing data right now in terms of sales basically off the charts. We're down where we were in the Great Financial Crisis, which is considered to be the worst housing market in the history of the United States. That's happening right now, and it's been happening, since 23 or so, and yet, I mean, outside of people that are directly connected to the mortgage and real estate world, are you hearing that much about it? No, and that's because if we look at our next slide, the home prices have stayed really high. And similar to the stock market, where just a handful of companies that are really, driving the market higher, it masks a lot of issues. The same thing with the housing market. The prices have continued higher, and so people are not really, I guess, noticing it as much that the housing market, in terms of the sales, are really in the doldrums.
And
Absolutely in the doldrums.
what an interesting point, Chris, because so many, I mean, it is a dream for a lot of people to quote pay off your house, right? That you no longer have a house payment, a housing cost.
Yeah.
And it seems really, solidifying, and yet, if this number starts to come down, think about how much you will have put into a property, and maybe suddenly not only is it no longer appreciating, but perhaps worth even less. And then I've seen a few videos on AI and robotic construction of houses and how that could potentially impact things. Imagine if the cost of creating a house exactly like yours is 80% less. And now you've dumped $700,000, $1 million, $2 million in this property, and as an asset class, real estate is now much cheaper to produce. That's going to cause the prices to drop. So, not to say necessarily don't pay off your house, but there does seem to be a little bit of a lull, and perhaps changes coming to me.
Yeah. Now, if you wanted to play AI outside of the obvious NVIDIA, Microsoft, Google, all the big players, maybe consider the small caps. Small caps have gone nowhere for the last 4 years. They have really been left for dead. And when you look at this chart from Kevin Gordon at Schwab, showing small caps relative to the NASDAQ, we've actually exceeded the difference that we saw in the dot-com rally. So Kevin says, believe it or not, there are times when the NASDAQ underperforms the Russell 2000, but that is clearly not the case right now. Now, if you went back to that last peak that we're looking at there in March of 2000, and you fast forwarded, small caps went on to absolutely crush the tech stocks for several years in a huge rally, to the point where if you were someone that basically was not in the NASDAQ but was just in small stocks, you really wouldn't have noticed that particular recession from a market's perspective, because all the pain was felt in the tech stocks at that time. So who knows what the narrative will be, what the change is, but all of these smaller companies incorporating AI in a more productive way to increase their efficiencies might be enough of a catalyst to start seeing increased profit margins and get some momentum behind small caps to start to see some mean reversion on this chart. And that same thing goes for the rest of the S&P 500. So I listened to a great interview with Jim Paulson on the Excess Returns podcast, and he was saying that 75% of the industries within the S&P 500 are actually selling at a discount to their historical price to earnings ratio. So you say, well, didn't you just tell me a few slides ago that the overall S&P is selling for, many turns higher in its multiple than it has historically? Yes. And that's because those industries that are selling at a premium are selling at a huge premium. But the rest, 3 out of 4 stocks within the S&P 500 are actually selling at a discount to their price to earnings ratio. So this chart here is showing an equal weighted S&P 500. So instead of market cap weighting, where you're giving the bigger stocks a bigger piece of the index, if you just equally weighted those 500 stocks, again, we're at extremes, getting to extremes that we haven't seen since that early 2000s era. And so, again, if you're looking for some opportunities, where are there still some good deals in the market? Where are there some areas where maybe the prices are not bid up to sky high levels? You might consider some of the rest of the S&P. This is from Jeff Weniger at Wisdom Tree. And he says small caps are 20.5% cheaper than large caps on a price to earnings ratio. The years that witnessed this discount are 1973, 1976, 1998, 2001, and 2020. Even investors who were early in 1973 and 1998 would have then witnessed two legendary small cap cycles from 1974 to 1981. So that's a 7-year cycle there. And then from 1999 till 2018. So again, you never know. This could take a year, and investing is dog years. So, if it takes a human year to get through this, it's going to feel like a really long time where every day you're looking at the markets, and the NASDAQs continue to outperform the small caps, right? But if and when that does change, it can change for a long period of time. And when you look at the probabilities, hey, what's the potential upside versus potential downside here? I think it's worth looking at. Last slide here, just to kind of further drive home that point in the extremes that we're seeing in the small caps. This is from Kevin Gordon again at Schwab. He must have really been fed through my algorithm this last week. He says the last time the S&P 500 closed at an all-time high was one trading day ago. The last time the Russell 2000 closed at an all-time high was 925 trading days ago. The longest streak on record where the Russell 2000 has not joined the S&P 500 in seeing a record high. The longest streak on record. So, probabilities and mean reversions and cycles, they usually play out, and it's just a timing. It's a timing issue.
And we are talking about the float going on in the market right now as we move on to the second half of our show. And Daren is going to show what that actually looks like, how they're actually floating higher, the S&P and more, as we take a look at some of the technical aspects of the market this week.
All right. Well, we're going to start with the S&P 500. So what you've got in front of you is the SPY. So this is a product or brand created by a company that tracks the S&P 500. So an investable kind of ETF or index fund. And so this is one way to visualize, to look at the market, to understand what's happening in the market. What this is visualizing for us is the 700 or the 500 largest US-based stocks. So this is a cap-weighted index, meaning that the bigger companies like Microsoft, Nvidia, Apple, Amazon, Google, Meta, and Tesla all get bigger boxes because they are a higher capitalization. Smaller companies get smaller boxes because they are worth less, according to the market. Now, we talked earlier in the show about the Nifty 50. See XOM right there? That used to be the biggest box on the screen for the S&P 500, and now it's not a very large one. Not the smallest, but certainly not the largest. I point that out to show you that things change, time changes, things shift. So will Microsoft, Nvidia, Apple, Amazon, Google, Meta, and Tesla remain the largest companies in the S&P 500, or will this shift over time? Time will tell, but when that happens and that rotation happens, that's sure to create a lot of volatility. So what you see here on your, this is a candlestick chart tracking the price.
And XOM is ExxonMobil, right, Daren?
Yes, is correct. Yes, it's ExxonMobil. Excuse me. So each one of these bars represents one day in the market. So if the market went down that day, it's green, or is red. If it went up, it is green. So today it looks like we're going to close up in the green. We still got 13 minutes to close. And you can see, so it started the day at the bottom of this candlestick and it's gone up. The little wicks, we call them, are these little, I guess, sticks sticking out of the candle. That's where price was during that period of time when the market was actually trading. So when we look at it on the weekly chart, you can see it's been a pretty good 5 weeks in the market. And that's that float higher that I was talking about earlier. Now, when we look at this, though, I also added a technical indicator for all the nerds out there like me. And this is what's called an RSI, a relative strength index, just to keep it simple. And basically what this shows you is what's the strength of this particular investment relative to itself. And anytime we get below the 30 band, we would say this is oversold. Time we get over the 70 percentile, we say it is overbought. You can see when it got oversold back here in this area, when we're going through our tariff tantrum, that was the bottom. When we get up to the tops, we tend to see the market dip. It wasn't particularly pronounced right here. It traded sideways and consolidated. But here's a good example of where it went over that 70 demarcation line and then went down after that. So what am I eyeing? I'm eyeing for the next, let's call it 4 weeks to 2 weeks, somewhere in there, 2 to 4 weeks. We'll probably continue to see some float, and then we'll see some weird news come up. There'll be something. I don't know what it's going to be, but there'll be something, and then the market will go, oh, because of this, I'm going to go down now, right? And so the question is it technically, or is it because something actually happened that made the market go down? I would debate that. We are coming into 640 on the SPY. If we look at SPX, which is also tracking the same thing, but the actual index, the S&P 500 index, we're approaching that 6,400 number, and we got rejected off that today. It looks like we might actually take that in the last few minutes. That'll be a really interesting close. So that could be an area of resistance right there, because we're coming right into that 6,400 mark. And whenever you got 64, a big even number on the chart, that's usually an area where magically some kind of news sells the market off. And we're right there. So I could see from just this technical standpoint that we get a little bit of a sell-off next week. And, maybe we, just because we hit 64 today, maybe we come into here and then go higher. What I'm looking for, though, going into September, is we really haven't seen a good test of this all-time high here that was set back in February. We broke above it, came down, sort of tested it right here, but then rose higher. I think in our next significant correction or event in the market in September, October timeframe, we'll see that test of this area right here, and then a resumption upward if we're going to continue moving higher. So that's the area where you'd want to watch that really closely on the chart and make some decisions for yourself. If we lose that all-time high of 61.51, then I think that we're looking at a trend change potentially.
Daren,
I don't see that.
I wonder if you could share too a little bit about the role of institutional traders and seasonality of the market too when we're talking about a summer float.
Yeah, so the retail buyer, the retail investor is getting much larger, right? There's a lot more retail participants in the market than there certainly has been in history, but relatively compared to the institutional buyers, it's pretty minimal. There's far more institutional buyers than there are retail buyers. And because of that, they have more influence on the markets, right? Well, traders work really hard. They spend a lot of time in staring at screens, and they like their vacations too, I guess. And so typically in the summer, there's less trading, right? There's this kind of it's not a spoken agreement, surely, but it's just a reality of people are away. They're on vacation with their families, etc. So that you don't typically see a lot of volatility, a lot of craziness in the July, August. Now school's going back in so much earlier. I wonder if that's changing the seasonality some. Like I have a kid going back first week of August. It's crazy. So it's more all year round. So I think that's changing things on some level. I don't know if you guys caught this, but Schwab is now allowing retail traders to trade almost 24/7 now. And that's becoming more and more prominent. And people can trade around the clock, which is also changing some of the sequencing of the market as well. So what we typically see is these July, August months are kind of float higher. There's less volume in the market, and the market floats higher because of that. And then when we get back into September, the market, there's a lot more volume in it, and there tends to be a lot of corrections that happen. I think the last stats I saw, 70% of the time in September, the market goes down. Don't quote me on that stat, but I think it's something of that nature. So that's what I would expect, right? And you should expect the seasonality of things. And then so we'll see this kind of rough market going through September, first 2 weeks in October. And then magically everything will just get better. And then it will ramp into the end of the year. You do have years like 2018 where the market went down in December. But that was an anomaly, right? That doesn't usually happen. You can see that going right back over to here where things really tanked in 2018 into 19. And that was Trump's first administration. And then we got the tax job acts and then the market just tore off. This is COVID right here. The COVID year, which is obviously a unique year in the market. But when we step back and really look at, okay, what's the market telling us? You have these big corrections like COVID, you have the tariff tantrum right here, and we just run really hard and really fast. And so it wouldn't be shocking. Now you can see this blue line. This is a long-term trend line and the market certainly seems to be respecting. And for everyone's understanding, I do put these trend lines in, right? So I draw these on the chart. Everyone draws their different. If you get rid of all my drawings, that's what the chart looks like. And then through my analysis, then I'm looking at just key points that I think are important to take note of in the market. So like if we were to get a major correction, what am I looking at? I'm looking at, well, maybe this 56. Certainly we're looking at correcting into that all-time high. I think that's our next stop. I think we walk into end of August, September, we get a nice correction into that 61.51. Probably find support there, which magically is going to correspond with this long-term trend line that we have on the chart right here. You can see it was rejected there. It was support here, and then it was tested support there. And then I could see that test come right in here, which will correspond with that 6,100 on the chart. So I think that's a pretty important psychological point on the market, and that's what I'd be looking for over the next few weeks. Let's go into the bond market, right? So most portfolios are made up of bonds and stocks. Bonds have been the pitiful performer and purgatory for those who invested in them, and everybody hates to hate bonds right now. The chart actually for bonds looks okay, right? So you can see this was a trend line that it broke above. It looked like it was going to lose it, but then it regained it. That's actually fairly bullish, Chris, which you will appreciate for the bond market. That looks pretty decent. That would tell us that we should be expecting rates to go down. That should be telling us that maybe that little visit Trump had with Powell yesterday had some influence, and we'll be seeing rates come down here in the near future. Certainly, the market seems to be thinking that at the moment. We'll see how it plays out over the next few weeks. When we look at gold has had a run for the records as of recent. And you can see it's just really moved up and now it's been trading sideways. This generally, I would say, is what we call a bull flag. And then that tends to go higher on gold. I am starting to see this as a distribution, though, where sometimes what you see happens is that it gets up here and then just kind of hangs out here and then it goes back down and that's it. High for gold for the time being. That's starting to form on the chart. The fact that it broke out of this trend line here, it broke out but didn't really do anything, kind of sat there, tells me that there might be, what happens is sellers up here start selling and selling and selling, and people buy, but then eventually the buyers get exhausted because there's so much selling in this area, and then that's when the market pushes it down. The thing with gold and with silver, for that matter, I think you start to see distribution happen because there are miners, there are people who have gold who start putting it on the market, and it's easy for it to push it down, especially silver, right? If miners see price of silver staying up, they'll ramp up mining and production, and then they can flood the markets pretty quick. That is why I like Bitcoin. And because Bitcoin, there's only ever going to be 21 million of them. And it's a true scarce network affected asset. And the chart actually looks pretty healthy for that right now. It looks like, but we looked like we were going to lose it earlier today, but the fact that it traded back up, I think that's positive. Market closes at 5 for Bitcoin, so kind of hard to read it at the moment. But lots going on in the crypto world with Trump putting in all the stuff he's putting in. So I think I would be shy if I was gonna get rid of or not want to participate in that arena. Well, I think we're going to leave it there for today. Kind of a deeper dive into the S&P 500 today, but that's what you're seeing. We're kind of at a correction point, although I think we probably float a little bit higher for a couple more weeks before we see that correction step on in. With that, have a great summer, everyone, and reach out if you need anything.
Thank you so much, Daren. Thank you so much, Chris. Let's wrap up the show, our Float Higher Summer Float episode. And a couple things to know. If this is perhaps the first broadcast you've watched for us, live stream, I still say broadcast. If this is the first video or audio that you listen to from us, we are Sonoma Wealth Advisors, our full family of brands, Sonoma Wealth Advisors, Fermata 401k, Fermata Tax. You can learn more about us at sonomawealth.com. If you're just enjoying the show and you want to see more of the show, make sure to subscribe wherever you are. We're on YouTube, Apple Podcasts, and Spotify. And most importantly, we want to say thank you. Thank you so much for checking out the show. We put in time every week. Education is a huge priority for our firm, and we appreciate your time to watch this. So we will catch you next week on the markets.